Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Dan Rohinton, Portfolio Manager at IA Global Asset Management, is our guest co-host. Then millennials and Gen Z are getting more financial advice through social media and are trading on gut instinct. Our featured guest, Liz Enriquez, founder and personal finance mentor at Ambitious Adulting, is here to explain the pros and cons. And we want to hear from you this morning on First Call. Call us with your questions on global large cap equities, and we'll have Dan answer as many of them as he can. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. You can also email us, firstcall@bellmedia.ca. Now, here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. NVIDIA has won U.S. President Donald Trump's approval to ship its H200 artificial intelligence chips to China in exchange for a 25% surcharge. Trump says he informed Chinese President Xi Jinping of his decision and that Xi responded favorably. Shipments would only go to approved customers. Chip makers, including Intel and Advanced Micro Devices, would also be eligible. Group Dynamite posted record operating income along with same-store sales growth of more than 31% in the latest quarter. The Quebec-based company also raised its 2025 guidance on comparable store sales growth. Dynamite says most of the tariff volatility is behind them, adding that they are seeing strong customer response with high traffic both in-store and online. Home Depot is offering a cautious preliminary guidance for the next year. The home improvement company gave projections for same-store sales growth and total sales growth that fell below estimates despite the forecast. The American company says it believes housing pressures will correct and their market will grow faster than the general economy. Home Depot also maintained its guidance for 2025. And now our top-line story, U.S. President Donald Trump, as we mentioned, has granted NVIDIA permission to ship its H200 artificial intelligence chip to China. Now, there will be a 25% surcharge. Let's bring in our guest co-host, Dan Rohinton, Portfolio Manager at IA Global Asset Management. Dan, thanks as always for joining us.
Thanks for having me.
Was this inevitable that this was going to happen?
No, I think it's a bit of a toss-up. And I think it's important just to explain because the terminology and nomenclature can be a little bit confusing at times. So what was previously approved was the H20. That was and we call it in the business the nerfed version of the H200, which is the more cutting-edge chip that's in all of the data centers as of last year. The new chips that NVIDIA is doing are called the Blackwells. And that's the new generation one, which are twice as powerful as the H200s. The next generation after that coming next year is the Vera Rubin, which we don't know the full specs yet, but we can assume at least 50 to 100% better.
Is it still following Moore's Law, a lot of these chips?
That's a very technical debate, and I would say probably.
Probably,
yeah.
Okay, sorry.
So
Random
probably
question.
is. It depends how you change if you talk about Moore's Law, is it shrink? No, that's slowing down.
Yeah.
But is chip architecture basically improving in its capabilities every year? Yes.
It is.
So I would say it depends on how you classify Moore's Law. But basically what this is...
But back to NVIDIA.
Yeah, back to NVIDIA. But it's true for NVIDIA too.
Yeah.
They're a core part of what Moore's Law is evolving into. What is going on with the Chinese conversation is a simple case of, what is the game that is being played? What is grand strategy? Is it winning the hardware war? Do you distill American technology to the world?
Everywhere, yeah.
Is that the chips or is that the large language models? That's the debate. NVIDIA would argue that it's the actual chips itself, and you want to maintain high market share so that you don't create a domestic competitor like SMIC, which has been climbing up the ranks. I think they've won that argument with basically a compromise, which is they give downclocked legacy chips that will be outdated relative to what Microsoft and Google are buying today, but it's a significant improvement for China. But if you think that China is going to distill its technology a lot faster through the hoppers, which are far more powerful than the H20s or what's available at SMIC, then the next generation of DeepSeek is about to get a whole lot better. And China is playing the open source strategy, as we've talked about in the past. So this is a very complicated chess game, and it depends on what you think the game truly is. I would argue that this is fine, and you're basically trying to blunt the Chinese semiconductor investments somewhat. Will it really have a demonstrable impact? I don't think so, and I don't even think it's a big deal for NVIDIA's financials. That's not to say it's not $10 billion of revenue.
Yeah.
But you got to remember, Roger, this company's going to generate almost $500 billion of revenue now,
So
on the order of
not
next
that
year.
much.
So it's chump change for NVIDIA. In the grand scheme of things, it's chump change for China too.
Now, does this China has talked about limiting? Is that realistic, or are they going to back off on that, do you think?
They're not going to back off. This is a no holds bar. I think I've joked in the past that when it comes to the power constraints, that these Microsoft is going to be burning whale oil to power the data centers. The same is true for China. So it is a no hold bar race to distill AI technology to your own domestic economy and around the world. So anything's in play.
Okay, so that China was talking about limiting who can get the new chips, the H200 chips. They were talking about putting a filter on, and you have to justify why you need these chips.
Oh, I apologize. Yeah, I see what you mean. Yeah. So the reason why that's brought up
And
is...
you think that'll stick?
No, I don't think that'll stick either.
Okay.
And the reason why I don't think it'll stick is, let's talk about why China's trying to do that. China's trying to do that because they don't want Tencent to be addicted to NVIDIA chips. When SMIC chips, they want to encourage development. So they're trying to cultivate their own semiconductor supply chain, as it's well within their right to do so. And NVIDIA creates a Band-Aid solution, and then you're on CUDA architecture, which is the programming language that sits above the NVIDIA chips. So it basically stifles domestic demand. But I think push comes to shove, they're going to fully allow unrestricted access.
And can China catch up, do you think? They're about a generation behind. Can they catch up?
The question, I don't know if it's a question of catching up to the bleeding edge of the frontier. We have to remember the computers are talking to us, and that's a leap in its own right. So there used to be this quaint little thing called the Turing test, which used to say, how do you know that AI is here? Is you can't tell if you're talking to a computer or not. Mm-hmm. I think it's pretty obvious that these models are very good already. So if China can just get to where we are today, and allegedly DeepSeek v3.2 Special already is, it doesn't matter.
All right.
So it's an interesting case of distilling versus the bleeding frontier. I would argue distilling is more important.
And we didn't even get into the geopolitics of it either. But we'll have to save that for another conversation. Right now, we're going to take a break, but we'll take a look at the markets before the bell as well. See how things are shaping up on the markets. We start with the U.S. futures. They are mostly flat right now. A little bit of green, a little bit of red, but that is about it. NVIDIA has been moving, of course, a little into the green as well with everything that is going on with it. We're all waiting essentially for the U.S. Fed and what it does. Major Asian markets, let's take a look there. And you can see actually the Hang Seng actually had a good day, but the Nikkei up slightly. CSI 300 down by half point. Hang Seng had a bad day. I was reading the green and red backwards there. Hang Seng off by 1.29%. Again, everybody kind of feeling things out, awaiting that Fed rate announcement, and a little guidance as well. And in Europe, how are they doing right now? In Europe, they are down right now. We're up a little earlier when I checked, but there is some gains in financials and industrials, but weakness in consumer names, that's pulling things down right now. FTSE 100 off, almost a wash, we'll say. CAC 40 off by 0.6. And the DAX down by 0.3. And the TSX, where did it finish the day yesterday? Yeah, another off day for it, down by 0.45%. Most sectors were in the red with the exception of some consumer and tech names that rallied. Let's see who the movers were, who the shakers were. Transcontinental, look at that, up by 19%. Celestica down up by 5%. First Majestic down by 4.4, and Curaleaf. It's had a roller coaster for the last little while. It's either having a good day or a bad day. It was off by 6.6. Taking a look at the metals now. Gold and silver both up on lower real yields. Copper, though, paying for some consolidation right now. It is off for the day, but for the most part, they are all having a good year. And oil. Western Canadian Select taking a bit of a plunge. They're up by nearly 3%. Apple supply, softer demand, putting pressure on oil. And taking a look south of the border, what did WTI do? Or what is it doing right now, I should say? It is up slightly, pushing that $59 a barrel again. Still, though, down after hitting 60. It's still down for the year. Well, PepsiCo has reached an agreement with activist investor Elliott Investment Management that includes a 20% reduction in its U.S. product lineup and a sharper focus on affordability. The soda and snacks company also plans to lay off as part of cost reduction efforts. The moves represent an early agreement with Elliott, as the maker of Mountain Dew and Doritos seeks to recapture growth and win back investors. For more on this, let's hear from our co-host Dan Rohinton, portfolio manager at IA Global Asset Management. Dan, this story, this guy got your attention, didn't it?
Yeah, I think it's just part of one thing to think about is this tends to follow the activist and the consumer staples cycle in some ways, but I think it's also a reflection of where we are as a whole. So what the normal cycle is, you go through these high growth periods, and this for Pepsi would have been decades ago at this point, but you go through this big top line acceleration, you scoop up all these different brands, then you go through the financial engineering where you move your bottling operations around, do some special dividends, do some basic financial engineering being, let's strip this cash flow here, let's outsource this. And then finally you hit the stage where, okay, the activists step in and then more sweeping changes need to be made. I'd argue this is probably a long time coming for Pepsi, and the changes will be painful, because when they say they're making changes, that means layoffs. And in this case, some decently sweeping ones, I would imagine, on top of the fact that you're also going to see, call it portfolio optimization, which in this case means selling off things like SodaStream. They have sparkling lime. They have all these brands that are not named Pepsi or Doritos. And remember, Pepsi is not just a carbonated beverage company that owns, Poppy Beverages and Pepsi Cola. They own Frito-Lay, which makes Doritos and all kinds of different chips and salty snacks.
Yeah.
Both sides of the businesses are under some strain, and they're going to make some pretty significant changes to try to get the ship back on track.
Well, they were talking about putting protein and fiber, adding protein, which is all the rage right now with foods, is adding the protein, but even fiber, I believe, in things like that. Are they chasing, or are they going to be ahead of the...
That's pretty normal. You know, consumer staples companies, they change. They take, what was it? The Greek yogurt was a big thing, and then suddenly everyone's got Greek yogurt.
I love my Greek yogurt.
There's nothing wrong with Greek yogurt, but now that you're putting protein in your chips to go with your saturated fats, that's the go-to trend now. So are they responsive as a company? Sure, but that's the marketing department's job. But structurally, are people moving away from these types of products? I'd say that's probably a bit oversold. I think the real story with consumer staples, and Pepsi is absolutely part of this discussion, is they just took too much price during COVID, and they leaned on price as a substitute for volume. And that's just to try to financially engineer your top line higher. Now you're at the stage where consumers are balking at the fact that
things are expensive.
Things are expensive, and the branded companies are going to losing share to private label, and consumers are just substituting away to cheaper products that are not these types of snacks. So I think all these things are coming at Pepsi at the same time, but I would say these trends were all building. It's just that this is the biggest company for this to happen to.
And do you think Pepsi can do it? Like what Elliott's pushing for? I mean, they're cutting product line, but they'll want everything else. Is that possible? Is there room for it?
I think there's room for it. The question is, on the other side of this, do you see a demonstrably different company? I would say probably not. Just ask Unilever. You know, they went through activists. They went through a lot of changes. Go talk about Nestle. So consumer staples tends to be the sector you trade because in general, all these large branded companies are losing mind share and market share a few years after that. And consumers are just moving on to different things. And this treadmill is pretty fast for them to keep up on. So and I think, let me just unpack that comment because I think it's an important one. In the 1950s, 60s, 70s, all the way to the 2000s, so the end of the newspaper era, you could be Oreo, and you could blanket America, you could blanket Canada, and everyone knew the best cookie in the world was an Oreo or Chips Ahoy or whatever Mondelez wanted you to think at the time. Or sorry, it was RJR Nabisco back then. Now, if you're a small startup, you can advertise some ultra niche product on Facebook or any of the other social media platforms, and you can get some scale. You won't be Oreo, but you'll have a chance to fight for it.
Yeah.
So that fundamentally breaks what is the umbrella portfolio company consumer staple moat. And this is just the 20-year lagged effect of that, and just happening to one of the biggest consumer staples companies in the world.
And to companies like that, do they need those activist investors?
Kind of, because you need someone to ultimately blame. So does the management at Pepsi realize they're probably overstaffed, which they probably are? Are they over extended on different brands and can't put enough budget for individual products or individual strategies? I'm sure they knew all that, but they need a nice boogeyman to say we were forced into it.
Yeah, and that's
so. That's Elliot's job.
And sounds like Elliot likes to do that because that name pops up on a regular basis as an activist investor.
Yep.
So where will we? What will Pepsi look like? That we're almost out of time. But what will Pepsi you think look like in say 5 years?
I think it's a smaller company. Smaller company because they divested. Probably a smaller company because consumer preferences and tastes have changed. Yeah. This just goes back to the secular trend is a secular trend. They don't have the branding mega advertising moat and the fact that you can block off shelf space at the grocery stores because Pepsi pays for what's known as trade spend, which is you basically are eye level on where in the snack aisle and things like that. Those days are not the same anymore. So I think the important story for Pepsi and why it'll be a smaller company years from now, and that includes the investors, but even if you say they don't do any of that, it'll still be smaller, is because the balkanization of the media landscape has broken Pepsi's structural moat, which was marketing and crowding out the little guy.
Okay, we're going to leave it on that note there, but we'll be back with Dan to have a look at what's on the radar for him. Oracle, watching that as the software company reports on Wednesday. Stay with us. Okay, time to see what's on the radar for Dan Rohinton, portfolio manager at IA Global Asset Management. And Dan has a few companies reporting earnings this week, and you're keeping an eye on a couple of them for sure. The first one, people might recognize the name, Oracle.
Yeah, and the reason why this is important, and they report later this week, is it's the litmus test for OpenAI. So there's this dynamic that's played out in the last few weeks in the market where if you're adjacent to Google and the Gemini complex, Gemini being their frontier large language model, you've had a pretty strong run. And if you're part of the OpenAI complex, which Oracle is, along with NVIDIA indirectly, you've had a bit of a tougher ride. And the reason being, the market is coming to the belief that if you're taking share, you're ultimately going to win the AI pie, and there's a winner-take-all mindset still in the market. Yeah. And Google's gain is ChatGPT's loss. So I think the thing with Oracle that's important to understand is they put a huge partnership with OpenAI, about $300 billion in remaining performance obligations, which is a long way of saying big revenue contracts for compute. And it's primarily training these models. And the market's asking the question, I think reasonably legitimately, but I think there's caveats to it, that if you're spending $300 billion and your revenue is 20-something billion today, that's a big hole over time. And granted, you spread it out over 5 years, but that's still $50 billion a year. So I think that's the debate that's going on. So it's on Oracle this Thursday to let investors know how they're going to spend the money on the compute, which is the NVIDIA chips, and how OpenAI is going to pay for it, and why everyone should feel comfortable with it. I think it's a bit overplayed. I think there's a short bond trade, a short CDS trade, credit default swaps on the belief that Oracle is a credit risk. I think that's way overplayed, but I think there's legitimate opportunities for Oracle to explain why this makes sense and why the profitability of this is more robust than the market believes today.
What do you want to hear from them that'll kind of ease?
Capital visibility. They need to explain how they're going to spend, because they're basically going to be spending something to the tune of $70 billion, I believe, by 2028, 2029, when it's the peak build-out years. Yeah. So you have to explain how you're going to get there, how you're going to finance it, because there is a cash flow deficit that they hit. So even Oracle, with all of the database revenues and profits it gets, 50, 60 billion a year is a big dollar to pony up. So they have to explain that. And the second piece, they have to explain why the OpenAI ChatGPT relationship is money good. And if it's not, can they do something else with it that's just good enough? And I think they need to answer those two questions. And if that's the case, the rest of the quarter won't really matter.
Okay, let's get, we got one more we want to get to, Broadcom.
Yeah, and ironically, this is part of the Google basket. And so
the yin and yang.
Yeah, the two sides of it, right? So, Broadcom, Avago Technologies, it's gone by different names. Same legendary semiconductor CEO, Hock Tan. They own what's known as the ASIC, or the Tensor Processing Unit, the TPU. Yeah. Think of that as just a more customized version of NVIDIA's chips. and they effectively do the same thing, but they're a lot cheaper. There's technical things that's not really worth boring everyone in the crowd with.
They're slightly different.
They're slightly different. Let's settle on that. But Google buys the TPUs from Avago. So the reason the stock's done really well is Google's success on top of the fact that Avago has proven that other customers are interested as well. Now the question is, that's all priced into the stock. This company used to trade at 15 times earnings, 18 times earnings. Now it trades at 40 or 50 on its way to 40 next year.
Wow.
So the valuation is in a total different stratosphere today.
Yeah.
Why that may or may not make sense ultimately comes down to, can Avago sign up more customers for what they're doing? And those revenues can't be a few billion at a time. The CEO's compensation package has about 120 billion of these revenues. So they need to become and prove that they're on the path to being the legitimate NVIDIA challenger that the market thinks that they are. And I think in that case, then the stock's going to have a good day. If there's questions or push-outs, I think it might be a bit of a miss. So you have in one sense with Oracle, pretty low expectations as a whole, I would say.
Yeah.
For somewhat good reasons. And on the other end, you have Avago, which has extremely high expectations, also for good reasons, but it's possible to miss very high expectations and come up above very low expectations. So it's going to be an interesting week in semiconductor land.
Okay, we'll leave it there. And we're going to be coming back, though. Still ahead, millennials and Gen Z. Can you say Gen Z? Getting more financial advice through social media and trading on gut instincts. Our next guest, Liz Enriquez, will explain what that all means. And, of course, our phone lines will be open soon for our first call segment. Call us at 1-855-326-6266. You can send us an email at firstcall@bellmedia.ca. NVIDIA has won U.S. President Donald Trump's approval to ship its H200 AI chips to China in exchange for a 25% surcharge. Trump says he has informed Chinese President Xi Jinping of his decision and that Xi responded favorably. Shipments would only go to approved customers. Chip makers, including Intel and Advanced Micro Devices, would also be eligible. Microsoft will be adding to its AI investments in Canada with a total of $19 billion between 2023 and 2027. The tech giant will build new digital and AI infrastructure in the country with new capacity set to come online in the second half of next year. Microsoft is also launching a new 5-point plan to promote and protect Canada's digital sovereignty, including protecting Canadian data from other governments, including the U.S. Campbell's posted lower profit and revenue in its latest quarter, the company says, despite at-home cooking trends continuing to benefit its meals and beverages divisions. Its snack business continues to face soft demand. The American company will acquire a 49% interest in Regina, the maker of aroused tomato-based pasta sauces. Campbell also reaffirmed its full-year guidance for 2026. And taking a look at U.S. futures right now, it is pretty much a wash across the board as we await the Fed rate announcement. With an Air Transat strike looming, CTV's Geneviève Beauchemin tells us what travelers who have upcoming flights booked need to know should the strike go through.
Travelers scheduled to take off aboard Air Transat are now trying to plan their next move.
I want my granddaughter to meet all my friends and, the people of Cuba.
Marlene Galliott's first trip to Cuba with her 9-month-old granddaughter is now up in the air. Her bags are packed and she has a ticket to fly out Saturday.
Should I cancel my hotel? Should we cancel the flight? Should we rebook? I have no clue.
Until a strike is actually triggered, says air passenger rights advocate Gabor Lukacs, the best move is not to make a move.
Until you actually get a cancellation notice, don't do anything other than planning. Have ideas for plan B.
Air Transat says it's offering passengers flexibility. Those booked to fly from now until December 12th can cancel for a credit valid for 12 months. But once passengers cancel their own flights, the airline could legally be off the hook for any other potential compensation. Air Transat has sent notices like this one to some passengers abroad, moving up the return home for some travelers on 4 added flights. The carrier says they will be entitled to a refund for unused hotel nights, but that's only if they bought a travel package including flight and hotel through Air Transat. Lukács says passengers should not make concessions to carriers and give away legal rights.
You should not have to cut your holiday or vacation short because Air Transat may be going on strike. And what Air Transat is doing is somewhat of a scare tactic.
Galliot hopes the strike will be averted and that she will be enjoying the sunshine in Cuba soon. But all the turbulence in air travel is taking its toll.
We love traveling, but now we have to think twice before we even buy a ticket to travel.
And another piece of advice from advocates to travelers is to record conversations they have with the carrier. Geneviève Beauchemin, CTV News, Montreal.
Well, many millennials and Gen Z are learning how to invest through TikTok and social media influencers, and often invest just using their gut instincts. Here to talk about the pros and cons of trading off of vibes is Liz Enriquez, founder and personal finance mentor at Ambitious Adulting. Liz, thanks very much for joining us.
My pleasure. Thanks for having me.
How reliable are those sources? What are your thoughts on them?
Well, I do personal finance content on TikTok and Instagram, and I definitely caution everybody getting information online. Anyone can start an Instagram or TikTok account and talk about whatever they want. So there's some caution that needs to be taken, but I also think it's an important way that people learn, and it's a route that a lot of people, millennials and younger generations, are using to learn about different topics, including personal finances.
Liz, do you think you can build the depth with the short form content that is a TikTok video or a YouTube short to really get to the nuances of a topic, or does it need to be structured in different ways where it's a series of 20-second clips, or can you really pack in the depth that you need to make these informed decisions?
No, I don't think in short form you can really understand the depth and all the information that's needed. I think what the short form does is pique the interest of someone who might not even be thinking about it, or might think, oh, it's not for me, investing is too hard, or investing is for a different kind of person. I think that the short form content helps them kind of see the basics of it, but then that should be the introduction, and then folks should be going to reputable sources, going on platform websites that have verified data, reading books, and doing some more in-depth research on their own. Probably if there's some trends that come up time and time again with personal finance content creators that are pretty universal personal finance lessons across the board. That is probably enough, but when you create strategies, more supporting data is needed to make decisions.
Now, I imagine this generation, though, is probably one of the more educated when it comes to it because of all this access they have to it. Not always perfect, but they're also going on their gut instinct on when they make decisions. How is that working for them, and your thoughts on it?
I think the gut instinct, we all have that gut instinct, and there's been cases again and again of people not knowing what they're doing, what they're investing, but following trends. I think of GameStop. I think of other kind of big news stories, even Bitcoin, when people are like, I don't really know how this works, but I'm going to go for it. And that's essentially following that gut instinct without having the context and understanding of how investing works and what you're investing in. And it works for some people, and this is a risk. When people think about investing as being gambling, I think this is what they're talking about, is when people just jump in without doing any research. And sometimes it pays off and sometimes it doesn't, but it's not the most sustainable strategy, especially for long-term wealth building. I always say, if you want to follow your gut, do it with a small percentage of your portfolio. Whatever you have, maybe it's just with $100 or $1,000 or whatever a small percentage of your portfolio is, can scratch that itch if you really want to see kind of where that goes. But the majority of your investing should be in a safer, more thought out and researched manner.
Okay, Liz, thank you for that. We have to wrap things up there, but thank you for joining us.
Thank you for having me. Liz
Enriquez is founder and personal finance mentor at Ambitious Adulting. Still ahead, We've got our eyes on Hollywood to see who will win Warner Brothers. We'll break down the latest with Dan Rohinton. And of course, our phone lines are open. Dan is taking your questions on global large cap equities. Call us at 1-855-326-6266. Or you can email us, first call at bellmedia.ca. Netflix or Paramount? Who will win Warner Brothers? That's the big question in Hollywood. Very dramatic. Let's check in with our guest co-host, Dan Rohinton, to get his thoughts on that. Dan, where do you see this heading? The latest, I was just looking at the Paramount up the Warner bid, and they had Trump's son-in-law at their side. Like it is it's a movie down there, isn't it?
Yeah, throw in a little nepotism here and there for sure. But let's take a step back and let's understand why is, from Netflix's perspective, from Paramount's perspective, and Warner Group as a whole, Warner Brothers Discovery. So Netflix is the juggernaut. They've got over 200 million subscribers, and they have global distribution. Then you have Paramount, which is relatively small potatoes. I think their main platform is Peacock, if memory serves correctly, and they're trying to scale up. And Paramount Skydance. So Netflix has scale, they have distribution, but they don't have multi-generational content. And what I mean is, you have Stranger Things, but Stranger Things is relatively new. Yeah. So they've got a lot of shows, but they don't have a library, like a Pinocchio or something like that. They don't have a Superman. They don't have a Spider-Man.
The heritage almost.
They don't have the heritage. They don't have those legacy anchor libraries that they can go year in, year out. So for the same reason that Netflix is interested, they have content distribution, but they don't have that type of deep library. This is a trophy asset for them. That's why they bid, I believe, $26, something along those lines. It was about $85 billion that they bid for it.
Yeah.
Then comes Paramount, which says, we're small, but we're backed by Larry Ellison, and which is the Oracle founder, and Larry Ellison's son, and a bunch of the Gulf states, which are throwing in money, and then Trump's son-in-law, Jared Kushner, and the Kushner family, if you will. That's on the Paramount Skydance side. So they're making a bid to try to become competitive enough with Netflix, because HBO Max is part of Warner Brothers Discovery. So staple these two companies together, and you have something that is competitive with Disney and also Netflix, and you have a deep library that you can monetize for a long time. This is the more palatable deal for antitrust regulators before you throw in the sprinkling of nepotism that comes along. With having family ties if you're the Trump administration. But from Netflix's perspective, they're going to bid for it because it's the last major iconic asset. So unless Disney wants to sell Marvel, which they won't, or Star Wars, which they won't, this is the last piece that's really up for grabs. So the bidding war is likely going to continue. Where it ends, I'm not too sure, but where Warner Brothers Discovery was starting from was an extremely low valuation. So even though the price is up almost 250%, it's not that much of a stretch, and why $30 a share isn't a crazy number for a big iconic library set. But these are all, just to be clear, linear TV assets. They are seeing pressures. They are seeing that type of decline, and the movie window has shifted from in person through the cinemas to online and home premieres and things like that. So this is an asset which, if it's not sold today, the value is less tomorrow. Have no doubt about that.
When would they be spending too much on it? $35 a share?
It's tough to say, and the reason it's tough to say is you don't know what Netflix could do with it. If Netflix says, day one, we're going to flood a new Superman DC universe and reset all of that. We're going to expand out HBO Max to the world through Netflix subscriptions. So Netflix, I think maybe another way to say it is, I think Netflix can afford to pay a lot more. They have the balance sheet, they have the capability, versus Paramount Skydance. But the more likely antitrust deal to get through the line for legitimate reasons is Paramount and Warner Brothers Discovery together. Yeah. Because if you hand this to Netflix, Netflix effectively owns distribution and content in a way that few other oligopolies in the world are so top heavy. Right. So I think it's a tough one for Netflix to get through, but they're going to try.
Okay. I wonder if there'll be like storage wars where they bid them up just to try and keep bidding them up. We have more coming up on the street after the break. Well, as Bombardier showcased its newest jet, the company CEO says he hasn't checked the math on Saab's claim its fighter jets would bring 10,000 jobs to Canada. CTV's Omar Sachedina files this report.
Canadian superstar Tom Cochrane headlined the entry into service kickoff for Bombardier's Global 8000, an $83 million U.S. business jet the Canadian company is banking on to become a superstar in the sky.
So this is the fastest airplane that exists on Earth right now, built here in Toronto. We should be very proud of that.
In an exclusive one-on-one with CTV News, Bombardier CEO Éric Martel says the jets have become its bread and butter, propelling its remarkable turnaround for a company that nearly a decade ago received hundreds of millions in government bailout for its C-Series passenger planes, which failed because of cost overruns and technical delays. Now it's extending its reach into defense to build on its success.
Perhaps Bombardier's dreams are greater than its ability to pay for them. You, of course, want a piece of the pie from these billions in government commitments that we saw in the last budget. What do you say to those critics that you're extending your hand too far?
This is a very fair question, and this is something that I think we learned from what happened in the past. It's not like we're designing a jet fighter or something else. We won't do that. But it's what we're doing is we're taking, the existing platform, and we are helping people to integrate their system. The risk for us is very minimal.
The latest potential move is to deepen its 15-year relationship with Saab, which is trying to sell Ottawa on its Gripen fighter jets. The Swedish company says Bombardier would assemble the planes in Canada, creating up to 10,000 jobs.
Which would effectively be doubling your Canadian workforce, because currently you have 12,200. I mean, is that a realistic number?
Yeah, I think when they say 10,000, they probably also look at the whole maintenance after and support and service. The reality is those planes will be built. We'll need X thousands of people probably to build it with the supply chain.
So the number, is it realistic or is it?
I don't know. I haven't checked their number, but they came up. But I'm assuming that it's also including the all aftermarket and support for the next 30 years.
So these 10,000 jobs are not necessarily direct jobs. They could be indirect jobs. Do you think it'll happen?
I don't know. I'm not in the secret in Ottawa, so I know some people are thinking about this very seriously right now.
But obviously, it would be a substantial plus for your company to have this decision be made in Saab's favor. So you could join with them or pair with them.
Absolutely. So we could be, as I said, we've been a partner for a long time.
For now, the primary focus, business jets. Last month, the Canadian government removed a 10% luxury tax on private jets, which is helping. So is the fact that aerospace is mostly exempt from Trump's tariffs.
Actually, it was free trade since 1979, even before NAFTA, and even, of course, before USMCA. So it's a bit of a global agreement that, country can do aerospace parts to other country, and there will be no tariffs.
But as there is talk of USMCA being revisited or reviewed next July, is there concern that perhaps aerospace could be included?
There's always
tariffs?
concern.
Especially for a jet like the Global 8000, which includes parts and assembly from Canada, Mexico, and the United States.
I'm always thinking of Plan B, Plan C, Plan D, but the reality is, as I said earlier, I think common sense will prevail.
Despite the headwinds, for today at least, Bombardier is celebrating. A Canadian plane sold to a Canadian buyer. Billionaire and waste management mogul Patrick Dovigi.
On Notable Call, we are continuing to focus on the airline sector. Let's take a look at some of the notable analyst calls and recommendations from BMO this morning. BMO Capital Market has initiated coverage of American Airlines with a recommendation of market perform. The price target is set to $16.75, implying a 13% increase from last price. The firm also initiated coverage of Delta with a recommendation of outperform. The price target, $80, implying a 19% increase from last price. And BMO Capital Markets initiating coverage of Southwest Airlines with a recommendation of market perform with a PT set to $43, implying a 13% increase from last price. Now, for more on the North American airline industry, let's bring back Dan Rohinton, Portfolio Manager at IA Global Asset Management. Do you go anywhere near the airlines?
We tend to stay away, but I think
Yeah.
it's one of those things where if you're taking a broader perspective on the airline industry and the U.S. airlines in particular here, it's a question of, is supply going to be reasonably constrained? That's really a question for Boeing and Airbus and their ability to pump out more jets. If that's the case and they can't really produce as much and the fleet ages, there's this natural demand pull that comes with everyone wanting to travel more,
Yeah.
the experience industry continuing to grow on a secular basis. So that just keeps the demand side growing and the supply side can't catch up. So is United Airlines, American, and Delta in a fundamentally better place than it was 10, 15 years ago? Absolutely.
Yeah.
Is that because Boeing can't produce enough planes, or is it really their own volition? That's more of a toss-up in my mind, but I do think the industry is more investable today than it was in prior generations. And I think just quickly on the Bombardier defense arrangement, I think it's an interesting one, but I think it's important to just take a step back of this is more of a, call it a jobs program than it is necessarily a national defense program, because the Griffin fighter jet and the way that the Bombardier planes effectively, how does a business jet become a defense aircraft? It's basically the hull is the same, but what's inside isn't padded seats, but it's advanced avionics and basically sensor technology.
Yeah.
So that's all well and good. Does that mean that we need to buy the Griffin, which is more or less a legacy fighter jet relative to the F-35? I don't know. That trade-off's a bit more complicated for me. So I think this is more of a political calculus than it is necessarily a national security. Are we buying the best toys that are available for sale in the world?
In the sandbox, and we may not even see this actually come to fruition.
Yeah.
With everything the way it depends what unfolds with the U.S. So there's still lots to go before this actually happens.
And the F-35 program, just to quickly, is an extremely sophisticated program with a long tail. So I would argue, push comes to shove, we should probably go for the F-35, but we're not here to make those decisions.
We'll see what happens. No, we're not prime minister, are we?
Yeah.
Okay, when we come back, Dan Rohinton takes your questions on First Call. Time for First Call here on the street. It's first email. Actually, it's from David. Can I have Dan's opinion on FFH? Buy, sell, or hold at these current prices?
I think when you think about Fairfax Financial as a whole, across the board, is think of it as the property and casualty insurance element, which it's a significantly better operation than it has been in prior generations. So there was a time where this was a bit of a problem child for the company. I think it's really come into its own. And they were actually in the fortunate position where they didn't have to take losses on bonds as interest rates went up, and that was to the bane of the existence of a lot of the other insurance companies. So they're in this interesting position where they have a big investment portfolio that they could term out, or they could hold on and earn decent yields as well. Is it a screaming bargain where we are today? No, but I would definitely still hold it. And I think the index inclusion, which is maybe why our friend across the screen was calling in, that should drive a little bit more temporary, call it price appreciation. But I think of that more as a fleeting dynamic, not really a structural one. But I think when you think about Fairfax as a whole, I think it's a strong hold today. I don't think it's an obvious buy, and I also don't think it's an obvious sell.
Okay, so sit and wait for that. Next up, I want to call this. This is from Conrad. Can I please get your thoughts on Mr.? But MSTR, which is MicroStrategy. Or strategy now.
So, I mean, a few brandings later, it really hasn't changed. So what this company used to be is it used to be a small IT consulting company, if memory serves correctly. Then Michael Saylor basically said, I'm really convinced about Bitcoin, and decided to basically take all their cash flow and then some to buy Bitcoin, and then took on debt, I think it was converts. So basically every step of the way, it's to leverage up the Bitcoin exposure. And the whole idea being, I'm going to take on debt, which is paying 3% in fake fiat money, and I'm going to buy real scarce crypto, Bitcoin, and that's going to appreciate in value, and my debt, I'll be able to outrun the debt.
Yeah.
That sounds great.
On paper.
As long as Bitcoin keeps going up.
Yeah.
So what you see here is effectively, and I don't have much more to say on this, unfortunately, because it really is somewhat this simple, is this is an on-margin way of owning Bitcoin. So you could buy Bitcoin directly, you could buy it through Bitcoin ETFs or futures and all that, or you could basically buy Bitcoin on margin indirectly through the wisdom of Michael Saylor. And that's really what it is. So it's a Bitcoin vault in theory, more practical purposes. It's a leverage exposure on Bitcoin where every time the price goes up and he can afford to do it, he'll probably take out more debt to buy more. And if you think 10 years on, it's going to be a winning strategy, that's great, but you have to survive the liquidation along the way. So I would say this is a sell, just because there's simpler ways to express this view than the enigmatic person that is Michael Saylor.
Just looking at Anthony Scaramucci from Skybridge saying he's praising it, saying it's a really smart approach that will strengthen Bitcoin's focus strategy balance sheet.
We'll see. Yeah, we'll see.
All right, on that note, Dan, we're going to wrap things up. Thanks as always for joining us. That is it for us here on The Street. Thank you to Dan Rohinton, Portfolio Manager at IA Global Asset Management, for joining us today. And he's up next with the Open, and the markets will open in a little more than 30 minutes from now. Have a great day.